The Australian Financial Review.
Hello, I'm James Thomson, Chanticleer columnist at the AFR. Welcome to our weekly breakdown of all things business, finance and markets. With me today, as always, is senior Chanticleer columnist at the AFR, the great Tony Boyd. Tony, how are you?
Oh, thank you, James. And geez, it's nice to have a sunny day in Sydney.
Oh, yes. Well, it's not quite the same down here in Melbourne, but we won't worry about that. We've got a lot to do this week. We're going to take you inside the corridors of power in Canberra to examine the federal budget. We're going to account for the big news in the banking sector, and we'll give you our tips for next Tuesday's two big events. The RBA's rate decision and, of course, the Melbourne Cup. Tony Boyd, the tipster, is back. But first, Tony, we seem to be talking a lot about hacking in the last few weeks, and the situation at Medibank has gone from bad to worse to utterly ordinary. Now the company is saying that the personal data of its 3.2 million customers is potentially at risk. And what's been amazing here, Tony, is how little control of the situation Medibank actually seems to have. You get the sense that they're waiting for the hackers to tell them what's happening rather than predicting what's going to happen next themselves.
Yes, James, it's just been absolutely chaotic. And, from that first press release, which said there is no evidence that customer data was accessed, to where we are now, where every single member has had their information released to this or stolen by this hacker. We don't know how many past members might also be involved. It's interesting, the analysts are coming out and trying to estimate how this will affect their business over the longer term. And there's numbers like losing 5% of their customers. But I think that generally with these things, people will stick around for remediation.
Yes.
Maybe the company's going to pay some money out, so it might be sensible to wait for that. I suppose the bigger issue is picking up new customers. I mean, would you go to Medibank Private now yourself?
No, well, I think you're exactly right. You sort of got this terrible situation where you're a customer, an existing customer or an old customer, sort of waiting for the hammer to drop, waiting for the bad news to come that your data's been hacked. And all of those 3.2 million customers, that's a fair chunk of Australia. They'll have family and friends who'll be sort of sitting there in a similar state, and that's going to make it awfully hard for them to keep customer growth as good as it's been. And that's the irony here for Medibank. They've actually done a really good job of winning customers in the last few years and restoring their growth. And now this is going to blow it up completely.
I mean, one thing going in their favour, of course, is the COVID deferred claims. So they're getting all the premiums for patients who might use doctors' services in hospitals. But of course, that hasn't been happening. So they've got a very strong balance sheet. The other aspect of this is that the government, I believe, has told them don't pay the ransom. So they're sort of being held up as the company doing the right thing for Australia. And that might actually work into their favour of David Costco, the CEO, who has clearly not been investing enough in his technology protection measures.
Yeah, I'll be interested to see, Tony. I think it's probably going to be a year to 18 months until we know the complete hit to customer numbers, because people's policies roll over at different times, and so retention rates could take a while to fall off. They said, the CFO said this week that the retention had been pretty good in the last few weeks, but that was, of course, before the really bad news emerged on Tuesday. So let's see, but every company in Australia is now on notice for hacking, aren't they, Tony?
Yes.
Most companies are just waiting.
You would think so. And it must be particularly concerning for financial institutions. I think Shane Elliott, was sort of talking about this week, how much they get attacked and how much they have to protect their own customers. And that's so far been working very well.
Yeah, that's the ANZ CEO, of course. Now, Tony, it's a very auspicious day today for the Financial Review. We've published in the Financial Review magazine the latest edition of our Young Rich List. Now, I'm a former Rich List editor, so this is a topic dear to my heart. And it's not often we can say that the rich have not got richer, but actually poorer. So this list ranks the 100 richest Australians 40 years and under, and it's all got to be self-made wealth, so no inheritance. But their their combined wealth this year has fallen by 11.1 billion or 27%, and that's down to a 4-year low of 30.2 billion. Tony, what's happened?
Well, look, there's a big proportion of those young rich listers who are from the technology sector, and there's some great coverage in that magazine that came out today, and it talks about how revenue multiples for tech companies have crashed. And what I find really interesting about that, James, is that there was a bid today for Nitro Software. We've seen bids for Nearmap. Australia's listed technology companies have been smashed just as heavily, down to revenue multiples of about 3. And the Americans, of course, are looking over here with a cheap dollar. And that's what's happening. Private equity's coming to buy them. But if you're a rich lister with a private company, it's a very different kettle of fish. You've basically got to keep going back to private capital markets to get more money. And even in the rich list, there's many people who've said that that's a bit of a struggle for them. So, I mean, who are your favourites in the list?
Well, look, I've got to give a big shout out to our 2 rich list editors, Julianne Sprague and Michael Bailey. The bit of these lists I love is the debutantes, the people who've managed to get on the list, and doing it under 40 years of age is impressive. There's a bit of star power on this year's list. Tones and I, the musical artist, has made the list. She's had a massive few years. I think she was busking in Burke Street, 5 years ago, and here she is on the young rich list. That's an impressive move. There's a lot of tech guys coming on the list, but one I wanted to call out was Scott and Mina O'Neill, who have a commercial real estate agency called Rethink Investing. They set it up 7 years ago. They've done about $2.5 billion worth of deals. It's interesting, Tony. Sometimes in Australia, the old school sectors, real estate, still manage to pull in the big bucks.
Yes. I mean, one thing that really impressed me was the number of women on the list. Yeah. Both as individuals in their own right, worth a lot of money, but also with their partners. And there's, I think, about 14 separate entries for women. And that's pretty good when you compare the fact there's only 7% of the top 200 ASX companies have a woman as their CEO. So it looks as though the emerging companies are doing a lot better on gender diversity.
Yes, absolutely. It's a very promising figure. Well, Tony, let's get into the very serious business of this week, and that was the federal budget. And you made the long drive to represent the Chanticleer team in Canberra. You headed up there Monday, and on Tuesday you were ensconced in the Financial Review's Canberra Bureau, where even Treasurer Jim Chalmers stopped in to have a chat. Tell us a bit about what the mood was like on the ground in Canberra.
Yeah, well, look, walking around the corridors of Canberra during budget time is always very interesting. Everyone's trying to guess what rabbit the Treasurer is going to pull out of the hat. And I think this year it was the social housing accord, or the Australian sort of the government trying to coordinate all sorts of different players in housing. But yes, on budget night, the Treasurer always comes around to all of the media outlets and has a bit of a chat to the editors and other people. And in this case, I thought it was interesting that he brought, or with him, alongside him, was Katie Gallagher, the finance minister. Now, she's the person who's been responsible for that spending audit that saved $22 billion, which in effect covered their $18 billion in election promises. But I got the sense from conversations with people while I was in Canberra that she is going to be the one who's going to be trying to drive lots more savings to try and get this deficit that we have under control. It's $1 trillion in debt by the end of the 4-year forward estimates of the budget in 2025-26. So they've got to try and make a dent in that whilst, investing for growth, I suppose.
Yeah.
What did you make of the budget out of Melbourne?
Well, look, I think you're right, Tony. I mean, in the next few years, we're going to have to make a big effort to find savings, and that feels like what Chalmers is softening us up for. But the problem he's got is we've got these sort of 4 pillars that are going to be really hard to break, or where it's going to be hard to cut spending. So we've got the NDIS, clearly one of the great sort of social programs of the last 20 years, but also very expensive. And you want to make sure that we're that's run as effectively as possible so it delivers the biggest bang to the people who need it. We've got a big defence budget that's getting bigger as geopolitical tensions rise. Aged care budget, we need to spend a lot more there to improve the level of care and service provided to elderly people. And of course, the health budget's rising. So it's hard to see, Tony, exactly where the savings comes from. Does that lead us to think that there'll be an upwards push on tax increases?
I think so. For example, this week I got a copy of a review of the venture capital tax breaks that have been put in place by the Turnbull government. Now, that was a Treasury review which was released by Ed Husic, who's the Innovation Minister, and also he's the Minister in charge of manufacturing. And I think we'll see a lot more papers like this. What Treasury found was that the venture capital tax breaks have they can't find any material impact of that measure upon the amount of venture capital that's being invested in Australia. So that's an interesting finding from a part of the bureaucracy that's never really liked any type of tax breaks. So after we'd had a chance to digest the budget numbers and talk to all the influential people in Canberra on budget night, somebody in the office in the Fin Review office said, they're coming after the Fin Review readers. And by that, I think he meant family trusts, superannuation that has, $10 to $15 million in it. There's likely to be some backlash against the way wealthy individuals are managing their affairs, including tax minimisation. And I think that's something that we're going to see Katie Gallagher really focusing on as we have another budget in May. It's barely 7 months away.
Just around the corner. Now, we had the budget in reply speech last night from Peter Dutton. I guess the sort of headline that the Financial Review took out of it was that the coalition's not given up on the idea of using superannuation to help buy a house. Look, it feels to me like this idea is a bit of a dead horse they keep flogging, but do you think there's any life in it?
No, I think it's as dead as a doornail, James. I mean, it defeats the purpose of retirement savings, and they tried it as a last-minute effort in the election, and I think you'd have to say it flopped then.
Absolutely.
Can't see why it might rise from the dead now.
Yeah, couldn't agree more. Now, let's sort of cut to the chase a little bit here. We've got deficits as far out as the eye can see, a decade worth of deficits. Do you think this sort of signals that the public's and perhaps the media's obsession with getting the budget back into surplus is sort of waning and we're sort of happy to live with a decade of deficits?
Yeah, look, it's a good question. I suppose people have to manage their own household budgets, and they look to politicians to do the same. If you tell people, for example, that the Future Fund, which is $200 billion, doesn't have enough money to manage the liabilities of public servants, and many of them former politicians who are on very generous superannuation plans, far more generous than anything that you would have found in the private sector. Those sort of things are going to be on people's minds. And when the NDIS, which is the National Disability Insurance Scheme, I thought I should just spell that out.
Of course.
Is potentially going to be about $100 billion a year by 2032. I think people will see that it's already bigger than Medicare. So there'll be pressure on people like Bill Shorten to manage that program in a more cost-effective way. And one of the more interesting aspects of the NDIS is that about 43% of the money goes to children under the age of 14. So how he does this is going to have to be very sensitive to, what Australians expect to get from, in return for paying taxes.
Yeah, well said. And to that point, I think we are getting used to living with deficits. I think the heat has come out of that politically. Australians are sort of understanding that we've had to spend an awful lot to get ourselves through the pandemic. These big programs like the NDIS, they are important to the country and sort of who we are as a country. So It just feels like a deficit being a deadly thing politically has moved away. So let's see how Labor handles that in the next few budgets. As you say, we're not that far away from the next one. Now, Tony, while the Treasurer was trying to balance the books in Canberra, we were getting a look inside the books of the biggest banks in Australia, and in fact, some of the biggest banks in the world. On Friday morning, we had Macquarie reporting its half-yearly results to the 6 months to September 30. You've had a look at this. What does it tell us?
Well, I think it tells you once again the advantages of having a diverse array of businesses in your portfolio. And I thought it was extraordinary, actually, when you compare Macquarie's performance with some of those big Wall Street investment banks who have trading rooms full of people sitting in front of Bloomberg machines trying to make money out of volatile markets. Well, the way that Nick O'Kane, who runs the Commodities and Global Markets division at Macquarie, is going, I reckon he's going to be, once again, the highest paid person at Macquarie for 2023, because the way it's going, they're shooting the lights out in a lot of areas. Now, remember last year he got 36 million,
right,
which is 5 million more than the CEO, Shamara Wickramanayake. So, there's some extraordinary numbers in there. For example, their net interest and trading revenue was, in some parts of the CGM or commodities business, was up 79%.
Wow.
They offer hedging services for foreign exchange. They do a lot of energy trading. So there's certain things that are happening in the world caused by the Russian invasion of Ukraine that are actually helping Macquarie.
Yeah.
Whereas, their Macquarie capital is not so great.
Yep.
But you were really writing a lot about ANZ. What did you think about that result?
Yeah, well, ANZ was out on Thursday, and I thought it was a pretty good set of numbers. Obviously, the big thing here is that rising interest rates are starting to make a difference. So the bank's profit margins, which in banking world is called the net interest margin, that jumped from about 1.56% at the start of the 2022 financial year to 1.8% in September. Why? Because interest rates are going up, and while the banks are quickly passing through those higher interest rates to borrowers, they're passing through to savers in their deposits. Those higher rates are going through a lot more slowly. So there's a gap opening up between what the bank lends money at and what they borrow money at. So that net interest margin's the focus for all of the banking industry in Australia. How high can it get? And based on ANZ's numbers, it's going up nicely, and with more interest rate rises to come from the RBA, it could continue to rise. But there was a bit of concern about costs, Tony, wasn't there? Yeah,
definitely. The costs they've forecast will go up by 5% in the next year, which I worked it out at about 450 million. See, the problem is, James, they've got to run two retail banking platforms side by side,
yes,
while they switch all their customers over to ANZ Plus. And that's, just the fact that the legacy systems, no one invested in them before or were able to change them over. But interesting to compare ANZ's retail bank with Macquarie's, because Greg Ward at Macquarie, he's really got that machine humming. He's doubled the amount of deposits to 100 billion over the last 5 years. He's winning market share in home. I think he's now got 4.5% of the country's market share in home loans.
Right.
And it's just a really good performing business. The profits are up 20%.
Yeah, it doesn't have any of those legacy issues that ANZ has. No old systems. Macquarie's retail banks all build on new, fast, cloud-based systems that give him such an advantage in that market.
And what about Switzerland, James?
Yes.
Obviously, Credit Suisse, one of the most troubled sort of banks in the world at the moment, came out with a restructuring plan. Does it have any credibility to be pulling an old CS First Boston name out from 8 years ago? Yeah, so what they've done is, to Tony's point there, is they've restructured the investment bank and they're going to call it CS First Boston. They're still going to spin it off from the main Credit Suisse. Credit Suisse will retain a big shareholding, but there'll be outside investors and the bankers themselves will get equity. So this is will this work?
It's a great question. I mean, last night they raised $4 billion, or they announced that they will raise $4 billion US. The whole joint's only worth $10 billion US. So that shows you how desperate this is, how big a roll of the dice this is. I think it's a step in the right direction. They're sort of trying to simplify the bank, selling some unwanted assets, focusing the main Credit Suisse on wealth management, on asset management, and on markets businesses, and their Swiss bank, of course, and then they'll restructure the investment bank. I think that's the part that we don't know. Will that restructure work? The stock was off 19% last night in its biggest one-day fall ever. So that probably tells you what the market reckons. And there'll be probably some nervous bankers at Credit Suisse offices in Australia just waiting to see how this plays out. Well, did you have a look?
Yeah, look, I thought one very interesting fact was that the Saudis were asked to come in and take a 10% shareholding.
Yeah.
Now, they've done that before when the banks in the UK were in crisis during the GFC in 2008, 2009, and they did very well out of putting money into Barclays. And I think prior to that, the Saudis put money into troubled banks in America. So they're pretty astute. And
yes.
Maybe they've called the bottom on this one.
Maybe.
What is it? 3.88 Swiss francs.
Yes.
Maybe this is it. It's the big turning point.
Oh, gosh, yes. It's one of those can you catch a falling knife situation, I think, but play with caution. Tony, a big question as we head in the next couple of weeks, we'll see Westpac's results and NAB's results. How high do you think bank profit margins, these net interest margins, can get? 1.8% for ANZ in September. Can they get back above 2% as interest rates continue to rise?
Yeah, look, possibly. I'm not sure. There's so many different pressures that are happening in the banking industry. Will people go back to, will they switch their old fixed loan at 3% into a new fixed loan at 6%, or will they go to a variable rate loan, which tend to have better deals for people getting discounts for, higher levels of deposits? I'm not sure it'll get that much higher, James. What do you think?
No, I think it's going above 2%, but I think that window might be relatively brief. There's a bit of a sugar hit going on, and we might see net interest margins get above 2% for 2023, but by 2024, I think you're right. They might be under pressure again as competition starts to bite, and perhaps there's a bit of political heat too about the bank's profit margins expanding too quickly. So I think we'll have a small bump and then we might be heading back again. But of course, what's really important to that is going to be what the RBA does. And that's what we're going to talk about when we come back after the break. Okay, Tony, Tuesday is, of course, Melbourne Cup Day. We'll get to that in a second, but at 2:30 on Melbourne Cup Day, half an hour before the big race, the RBA makes its next big decision on interest rates. This decision has become somewhat more complicated by the inflation numbers we saw this week, 7.3% inflation, much higher than expected. The pressure is rising for the RBA to go harder, isn't it, Tony?
Yes, well, you've probably noticed a number of big-name economists like Bill Evans, Joe Masters. They've all come out and said the bank's going to go 50 basis points because that inflation number, what highest in 32 years, was just so big and out of the ordinary. Look, I think they'll just go 25 again. I think they've got to watch and see and find out what the impact has been on borrowers of, we've got 2/3 of home loan borrowers are on variable rates and they're going up very sharply. So, yeah, that's my tip. What about you?
No, I've hardened to 50 basis points. I talked to the Coles chief executive, Stephen Kane, the other day, and he is seeing only inflation only going in one direction, that's up. The food prices will continue to rise. He's seeing construction costs rise. Transport costs aren't coming down. Supply chain issues. And people are still spending. I mean, the spending rates that we're seeing from the numbers from ANZ and other banks say that the consumers are not pulling their horns in. And I think the RBA is going to have to send a message. So that'll be very interesting to see. 2:30 on Tuesday. Half an hour later, Tony, is the race that stops a nation, the Melbourne Cup. Now, we've been burned badly by your footy tips in the AFL and in the NRL. But I wanted to ask you, but you have a special connection to a runner in the Melbourne Cup. Tell us a little bit about this.
Oh, well, look, yeah, this is a bit of a personal story, James. My late brother Chris had a tremendous interest in horses, and when he died a few years ago, he left to his two sons a little portfolio of horses, some interest in horses, and one of them is a New Zealand horse called Stockman, trained by a guy called Joe Pride from Warwick Farm. Now, it's actually made $1.3 million in winnings. I think it's had eight big wins. It's just coming off a win at Randwick. Yeah. He loves the wet. Now, you said it's raining in Melbourne. Maybe that's going to work to his favour, but from what I hear, it's the worst field in history, so Stockman might have a chance.
Well, I love it. It's very exciting to have it. Any connection to a Melbourne Cup runner is exciting. So can only wish you all the best there, Tony. I'll be working at Melbourne Cup Day, bringing AFR readers the news from the winner. So hopefully I'm talking to Stockman's trainers and fellow owners on Tuesday as we look at the Cup. Tony, each week we get some great questions from our audience, and you can add your question by sending us an email at chanticleer@afr.com. Today's question comes from Delia French of Roselle, who asks a brilliant philosophical question. What is worse, inflation or recession? I hope you're going to go first here, Tony.
Okay, well, having started as a finance journalist, I suppose you might say, just before the big recession of the 1990s, I'm pretty convinced that a recession is far worse than inflation. So we don't want to have a recession. So let's allow the world's central banks, including Philip Lowe at the Reserve Bank of Australia, to try and get this scourge of inflation under control and avoid a recession. Let's hope we can do it in a way that there's a bit of a soft landing.
Yeah, well, I think Jim Chalmers, the Treasurer, nailed his colours to the mast. He said inflation was public enemy number one this week after the budget. I think there might be a middle ground. If we had a recession that was fairly mild and that didn't see the unemployment rate jump too high, but helped take the heat out of inflation, that could be the sort of Goldilocks path. So, yes, we might enter a technical recession, but our labour market's so strong that we shouldn't see a big jump in unemployment. So perhaps there's a path we can walk through where we have a little recession, we get over it quickly, but we get inflation down and, the RBA can sort of have the best of both worlds. Possible, Tony?
Yeah, look, it's possible. I mean, as an optimist, I'm always going to side with that point of view that these people know more about the economy than we do, James, and they've got much better flow of information. So hopefully they've got the tools and the information to make the right decisions. Although I do see a lot of economists saying beware of a policy mistake in America. Yep. And that would have implications for the whole world.
Yeah, absolutely. Well, we'll see what the RBA does on Tuesday. And more importantly, Tony, we'll be cheering for you and your family and Stockman as he thunders down the Flemington Strait.
Okay, yes, no, let's all have I think it's like I say, spreading a bit of joy for the family.
Fantastic. Well, thank you for today, Tony, and thank you to our listeners.
Thanks, James.
If you like the podcast and you want to hear more, consider rating and reviewing us as it helps others find us. And follow us on Apple or Spotify or wherever you get your podcasts. At The Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to The Financial Review, the daily habit of successful people at afr.com/subscribe. Chanticleer was hosted by me, James Thomson, and Tony Boyd, and it was produced and edited by Lap Fan and Alex Gow. The executive producer is Fiona Buffini.
The Australian Financial Review.